Hey everyone. So today's topic is my number one options trading strategy for monthly income. And this is for beginners, this is for intermediate traders, this is for advanced traders, because I think of myself as somewhere between intermediate and advanced. And I trade this month in, month out, week in, week out. Well, I wouldn't say week in, week out, but this is my go to strategy for monthly income. What this does is it keeps me defined risk and it I know exactly how much money I'm going to make, and I know exactly how much money I'm going to lose in this trade. So I sleep well. I sleep better if I trade this strategy. And then if you look at my live account, I've made some videos on it as well. I don't 70% of my trades are credit spreads, and a lot of them are credit put spreads, meaning selling the put side of the market. Now, I know a lot of you, or a lot of the traders, and this was me as well back in the day. I would jump between strategies, one strategy, and if it doesn't work, I will move on to the other one, and if that doesn't work, and then in the end, nothing actually worked. So the idea here is, and then slowly, gradually, I learned like sticking to one, getting better at one, and then moving on to the other one makes you a good trader. It keeps you in check. It keeps your risk in control, and you will see results. Trust me, you will see that. I can guarantee that if you stick around with me, I will show you how to make your profitable trade. At least the first one, when you're hanging out with me, I will show you exactly how the profitable trades are made. I will not leave you until that first profitable trade is done and you have a positive P&L in your account. So the bull put strategy is my number one go-to strategy, and this is what I teach as well on a very regular basis. That it's not just bull put. In some underlying markets, we sell the bear call spreads as well. So it's basically the spread strategy. Now, why only one strategy is enough? It is, and trust me, one strategy is enough for you to grow your account. I've been growing my $5,000 account. Last year was a good year. The year before that was a very good year. Doesn't matter what the market does. If you have a good entry point, if you know how to manage the trades, and if you know when to take the trades off and not be too greedy, because the game is you don't want to blow out your account. You want to survive and keep trading, trade small and trade often. Like how the street says, you have to trade enough to get better at it and to make consistent profits. So it reduces overtrading for sure. It builds consistency. You will learn more and more about the strategies. You will learn more and more about the markets that you're trading, meaning the S&P 500 futures, all the futures markets, all the stock markets, ETF markets, everything. You will start learning where to actually sell the spread. Now, I know the S&P 500 futures. I know the crude oil market. I know the euro currency market back of my hand because I know at which turning point I need to sell which strategy. For example, if the crude oil market right now is has been tanking for a while, I would sell put spreads all day long in that one because the volatility is high, and I, as a contrarian trader, sell into the strength of the market, meaning wherever the market is, you sell that side of the market. If it goes down, you sell puts. If it goes up, you sell calls. That's the whole idea. Now, you don't need five different strategies. Trust me, especially if you're starting out as a beginner, you don't need five different strategies to learn options trading. Only one. Rinse and repeat. Only one strategy. And spreading out too much, too thin, you're spending too much capital into other strategies is not really helping your account because you are losing on one, then you're making on the other, then you're losing two on here, and then making one on here. So if you stick to one, you will master this skill and then move on to the next one. Now, what is a bull put strategy? Basically, you sell a put and then you buy another one down below. That's all it is. You collect some credit on this. The risk is your spread width, meaning the spread, and I have a whole slide on how much your spread width should be in each market or each underlying ticker. And I will add these slides in the show notes so that you can download this. It's pretty useful. I've spent a lot of time building this and creating this thing. So hopefully this will be helpful for you guys too, as much as it has been for me over the years. Our The last point here, directional bias. Now, my bias is basically sell into the strength of the market. If the market goes down, you sell puts. If the market goes up, you sell calls. Now, we don't sell willy-nilly. Like, we don't just go sell anything and everything. I will show you exactly how to pick the strikes, where to sell it, and what to sell. Now, here's the payoff diagram. Now, look at this. Spend some time looking at this diagram for a minute. This is your short put strike. This is where you will sell. And this is the strike that you will buy at here. If you can see the cursor here, this is the strike you will buy at. This is the strike you will sell. The difference between the two, or however much, is your max risk, which will be your max loss, right? Credit spread minus the width of the spread minus the collection of the credit. The credit is your max profit. Let's say you collect $2. That $2 will be your max profit. And let's say you spend $10. The width of your strikes are $10. So your max loss is $800, $8 in the options world. Fine. From your put strike, you need to deduct the amount of credit you've collected to get to your break even. This will be your break even point, after which point you will start losing money in the trade. But I will show you some proven hedging, adjusting techniques, which will save you on a rainy day and help you become a better trader based on how to adjust these trades. Now, look, I've put everything here. This is everything in my mind for the last 10 to 12 years, trading all these options, and I've dumped everything on this slide here. Sell between 16 and 20, and I'll take you to the platform to show you exactly what I mean. Sell between 16 and 20 delta, and buy between 12 and 13 delta. That's what your spread should be. Now, each underlying ticker I have, based on my experience, I have built a matrix of each underlying ticker and how much should the width of the spread should be in that market. I don't trade more than that. Maybe sometimes I will trade more contracts, but my width of the spread does not change. That is something that stays constant for me, and it has stayed constant for me since I have figured this thing out, and it has worked for me, over a long time. And then we aim for 80% plus probability of profit, and I'll show you exactly what that means as well. So stick with me. Let's go through some theory here. Now, I took this screenshot. I wanted to show you what I look at when I go onto the trading screen. My first go-to is the implied volatility column. This is something that I have in my view. You can have something different, but these are things that I look at. My 17 delta strike on the put side, my 17 delta strike on the call side. Now, my the long strike will be somewhere down below here. It doesn't show here, but I'll show you on the platform. The other more important thing is to look at the open interest. Look at the open interest column on both sides. It's in thousands. And this is the ES, E-mini, S&P 500 futures. This is one of our go-to markets. Now, this is what I was talking about. Like, what should be the width of the strikes in each market? I trade 25 points in ES, somewhere between 20 and 25, I should say. You can trade less, you can trade more. When I trade 20 to 25 points, I collect $150, and I put down, my buying power effect is 350 on average, but my max loss here is $1,000, or somewhere around 1,000, a little bit more than that, and I'll show you on the platform as well. The next one is a crude oil market, and that crude oil market is basically 10 points away. The spread is 10 points. I normally collect between 130 and 140, and I put down the same amount of money. Now, you can go through this chart. You can take some tips out of this if it works for you. If it doesn't work for you, then that's fine too. But this is what has worked for me in the past. Now, this is not my complete list. I would not, obviously not, I did not have enough time to go through the 40 tickers that I trade and put it here. This is a starting point for somebody who is starting in these markets. These are the tickers that I would trade if I was starting today, because these are the most liquid tickers out there, and these are the most liquid markets. There are other markets that we also trade, but these are my go-to. I would say maybe 50 to 60% of my portfolio is built out of these. So that's what I put. That's what I put here. Okay, when to use this strategy? Checklist. IV rank has to be high, over 30%. Sometimes we trade at between 20 and 30% too, when there's nothing happening in the market. The market is lull. There's not much volatility. We still trade it, but we take profits early. we take profits around 25 to 30%, whereas in high volatility environments, we take around 40 to 50% profits. You have to make sure there are no earnings. I don't trade within the earning cycles. So like right now, it's the earning season is going on. Most of it is done. So now is the time to like put things on and start your reps in this market. Higher IV means higher credit and means better reward for the same risk. So just remember that. Higher IV means you get wider break-even points, meaning you can stay wide and you still may not get tested in these environments when the IV is high. Okay, next one. So how do you manage this trade? Now I have two rule of thumbs. First one is when my P&L shows 120%, 5% off my initial credit. So let's say I collected $200 and now my P&L is around between 150 to 200 to 250. That's when I will think about adjusting the trade. That's one of my go-to. The other one is when my short strike reaches 35 delta. So I will show you exactly how it is on the platform. Again, this is the mini the micro ES, but micro ES is a smaller product for me. But for whoever it works, I have made some other videos on how to trade this on my YouTube account. Go check it out. It's called How to Trade S&P 500 Futures, where I discuss both the bigger one, the main one, and then the smaller one as well. So let it bring the data up first, and let us finish the slide here. So, and then what do you do? So what you do is what I do is this is what has been working for me is if my short put strike spread is tested, I will convert this into an iron condor, and then I stick with the iron condor piece. And then if I have more than 30 days left, I will stick in the same cycle. If I have less than 30 days left, then I move the spread out into the next cycle. And then I will trade it as if the iron condor comes in with enough P&L, I will take it. If each spread comes in with their own P&L, I will take it, and then I will manage each spread again separately. So again, these things are more understandable, or you will get more around it when I am there holding your hand and showing you exactly which buttons to click and how to trade these things. And for that reason, I am running this masterclass for next Friday, 16th of May. Try and join this. Sign up on this link. I will put the link on the show notes as well. Just sign up. We will be discussing these three strategies, and then everything else that a new beginner trader should actually go through. How to start trading these, and then no charge. This is a free class, and then just look at my history here. I would encourage you to step in. The recording will be available for maybe 24 to 48 hours, and after that, it needs to be taken down, because if I keep it on, then you will procrastinate on this. You will not watch it. You will keep delaying it. I want you guys to take action, and therefore the recording will only be available for a limited time. Anyway, now let's go through a real example on the trading platform. So I have selected ES E-mini futures, and I will go to my sweet spot, which is around 45 to 50 days. This cycle is 43. My first check is, where is my open interest? Okay, open interest column. Nicely, you can see nice numbers here in thousands on both sides. So on the call side, it is actually in thousands too. So I will stick to this. Actually, this is the week 4 cycle. Let me just open up the AM settle one. I think AM settle one is more liquid, if I'm not mistaken. Yes, definitely more liquid. So yes, AM settle one is, I think in the example on the slide as well, I put the AM settle one. This is the one I trade. So what are we doing here? Implied volatility check. So on your charts, bring in the IV chart on your brokerage platform. If it doesn't give you one, sign up for this one. I have no commissions going on anywhere, anything. Implied volatility is still high. On average, it is around 15 to 16. If I have to draw a line, look, this number is 17%. So meaning in S&P 500 futures or S&P 500 market, your overall annualized volatility is around 17%. But right now, in the April tariff fiasco, it went up. Best time to sell. Look how it always comes down. This is the number one thing that we look for. Volatility jumps, and then it always comes down, because look at this. Every time volatility goes up, it is mean reverting. It comes down to its mean level. Its mean level is 17. Every asset, every underlying ticker has its mean level. And if you look at the volatility of it, it comes down to its mean level. Now, for example, if you have to look for Apple stock, look at its last year's IV rank, not IV rank, IV. Look how it always comes down to its mean level. It is still it is still elevated right now. It's bid up, but look, if I have to draw a line, the line will be drawn around this number, which is 26%. Right now, currently everything jumped up early April, and then it all started coming down, and it will come down to its mean level. Don't worry about that. Within some time, within a few weeks, it will all be down here. So my aim is to show you a real example here. So I'm going to go back into my favorite market, which is E-mini S&P 500, and then let's take let's put on a put spread. Now, would I put a put spread on in this market when it's gone up quite a bit? Not really. Usually I sell puts around here when the market drops, but this is just for illustrative purposes. So I'm going to take a put spread trade on, but I'm also going to take a call spread. Let's do a call spread first, and then, because in this kind of market, but also one more thing, I try to stay away from call spreads in these indices, major indices, because they have a positive drift, meaning 80% of the time, 70 to 80% of the time, they just go up. So when they go up, you don't want to be in front of that moving train. So I sell puts because selling puts has been the best strategy for me in these indices. So actually, let's just stick to that short put side. Okay, my 17 delta sweet spot is around 5,300. Nice round number. Look at the open interest on that strike. It's 13,000 contracts. Each contract is $285,000. Remember that. Each E-mini contract, maybe even more right now. You can see it here somewhere. If I have to pull this up, yeah. If you look at the future side, look at go down and find /ES, which is here. Look at the contract initial margin is 22,000. Each tick value is 12.5. I thought it showed the total size of the contract too, but if it doesn't, all you have to do is just multiply the S&P index number with SPX number with 50, and you will get the overall contract size. Meaning, just multiply this number 1,500 times 50, and that's the overall contract size. Okay, let's do it. So right click here. Doesn't matter if you right click on bid or the ask, because we are selling a vertical. When you sell a vertical, now this is nicely 43 days out. It's my best. It's my go-to expiration cycle. So you have to right click and select sell, and then select vertical. Now look, it has already populated my long strike at 52.75, which is 25 points out, and I'm collecting $3 here. Three means I'm collecting 150. You just have to divide this by 2 to get your exact dollar amount, right? Now the next step is to take this into the Analyze tab and then see exactly what's going on, because you need to look at your Greeks as well. Looking at the Greeks is the second most important thing here. Let's take this long one out. Okay, here. So this is what our trade looks like. Theoretically, this is what it looks like. And then let me set the slices to break even, 621. And then always make sure this date on top is also break even. Now this range is showing you a 1 standard deviation range. Now if you want to look at my how to make a passive income video where I discuss all these standard deviations and ranges, go check it out on my YouTube video, on my YouTube channel. I recently made that video with a downloadable PDF that if you want to take it home. This grayed area is basically for 1 standard deviation move. You can change this to 2 standard deviation, but that is not how we work, because if we go 2 standard deviation out, that's too wide and we don't collect enough credit. So we stick around 1. What does this mean? What this means is 68 to 70% of the time you will the underlying ticker is going to stay within this range, within your grade area, and if it does, you make profit. That's what it means, right? Your max profit here, if you lock it up at 3, your max profit is $150 without commission. There's an option here to include commissions as well. If you include, then your max profit goes down by $5 because it will cost you $5 to get in, $5 to get out. But then yes, I agree, it's a little bit more expensive than trading outright stock and ETFs, But you get better leverage here, better capital efficiency in futures options market, and better everything. And that's why I trade this, even though it's higher commissions. Your max loss is $1,100, like I mentioned before. Now, right click, confirm, and send. That's it. I mean, these are the things we look at. The trade is set up. It looks good. 85% probability of profit, which I mentioned in the slides as well. This is what I look at. I like the number 8 in front of everything, which means I'm getting more than 80% probability of profit to trade this spread. Now right click, confirm, and send. Again, check a few more things here. Look, again, like I mentioned on the deck, this is what your buying power effect. This is how much money you will come out from your account right now to initiate this trade. If you were to trade the same thing and collect the same amount of money in Apple or any other stock or ETF, this number would have gone up by twice. It would have been twice as much, meaning it would have been around $700 to $800. Okay, that's why we trade this market, even though commissions are slightly higher. So $4.50 to get in, $4.50 to get out. That's $10. That's fine. But then look, I can put 2 of these trades for one of those in the other markets, right? That's the main advantage of trading futures options. So I've checked everything. Everything looks good. I'm going to send the trade in. This is my simulated account, so don't get me wrong here. If you are just starting, I would highly recommend to open one of these up with some money in there. I have 100,000. I don't really use it, but this is just for illustrative purposes. Send the trade in, and then see it should get filled, because it's just like, yeah, there you go. It's filled up at 325. Actually, it got better. So now my max profit is 162.5, because each tick is $12.50. Remember that. Again, if you're not sure about ES, E-mini futures, go check out the video I've made on the channel. And then that's it. If you look at the monitor tab, you have a trade which looks like this. Normally I have more things here, but I don't know where do they keep going. I mean, I keep adding them and then they keep disappearing. So I normally have delta, and then I have theta coming in. Theta, there you go. And then the other thing I do is I beta weight this to SPY. So everything is beta weighted to the market. Okay, do that and put it up. What that does is it will give you the beta weighted delta according to your main index, which is the S&P 500 index. Okay. This is the trade. If you have any questions, just let me know. Otherwise, I hope you enjoyed the video. Like I said, I should mention again, try and join this. It will be 1 hour and 30 minutes of just pure teaching of 1 hour, and then Q&A at the end of it. So hopefully I will see you there. Thank you very much for watching. Bye-bye.